I'm Pierre Daillie, managing editor of advisoranalyst.com. My co-host is Mike Philbrick of ReSolve Asset Management SEZC. And our very special guests today are Meb Faber of Cambria Asset Management and Marc Dalpé of Richardson Wealth. This is episode 1 of Raise Your Average.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
For decades, a balanced portfolio of stocks and bonds has been the highly regarded staple of investing. It's a concept that has been under fire well before COVID happened. But as 2020 unfolded, the 60-40 portfolio has continued to confound its critics. So that's what we're going to talk about, the 60-40 portfolio puzzle. With yields on 10-year bonds on both sides of the border descending to record low levels, Canada's are at 0.75% and US 10 years at 0.927%, and stocks climbing to all-time historical highs, probably as we speak. It's anybody's guess as to what happens the next 10 years. At sub 1% levels, can we look at government bonds for income anymore? Can we count on bonds to continue to provide the ballast to equities anymore? What about stocks? What are the forward-looking returns for stocks? And moreover, what stocks? For this very first episode, we've got two very bright and creative and successful people that we've brought on as guests to talk about it. One of them is Meb Faber. Meb is the CIO and founder of Cambria Asset Management, based in Los Angeles, California. They run some well-known ETFs as well as separate accounts for individual investors. Meb has an awesome podcast, The Meb Faber Show, where he's interviewed hundreds of other investors. He's a brilliant quant. We've asked him to come on and talk about what his answer to this dilemma is that we're all facing. We've also got Marc Dalpé, a very successful portfolio manager and advisor at Richardson Wealth, where he has run the Dalpé Millet Group advisory practice. Marc has been an advisor since 1990. I've known Marc since 2004 when I was the head of distribution for a mutual fund company specializing in India and China equities. Marc was way ahead of the curve as an advisor, and more significantly as a fee-based discretionary portfolio manager with both the use of ETFs and actively managed funds 16 years ago when we first became acquainted. Marc, Meb, it's really great to be with you. We're so excited to have this conversation.
Thank you.
Awesome. Great to be here.
That's great introduction and great way to set this up. Does anyone want to jump into, sort of just the more of the backdrop on where we are at all? Well, let me do a bit of that. So the historical reference point on rates is 5,000-year lows. So the lows are, sort of right at the bottom. And as Pierre alluded to, we've got, government bonds at 90 basis points. You go to the agency bonds at 1.2. You creep up to high grade corporates at 1.9. And so you've got a very small incremental bit of yield that you're getting each time you move down the balance sheet, as it were, in a corporate finance perspective. So that kind of frames the conversation and gets us, I hope, started. Any other thoughts on that from Marc, Matt?
Yeah, I got a thought,
Go ahead,
which is the when you said background, I said my background today is actually totally appropriate, which is, if you guys can recognize, or if the listeners or watchers can see it, it's from the movie Up, which, if anyone has watched, basically the entire audience is crying. No spoiler alert, but the entire audience is crying in the first 5 minutes. And then the movie proceeds to become a warm and happy movie for the rest. And I think that's a good analogy for 2020, where we are. First quarter seemed like the zombie apocalypse, very dark times. And then, probably to a lot of people's surprise, here we are at all-time highs in many markets ending the year. What that sets the stage for, I think we'll talk a lot about today. But I'll kick it over to Marc and hear what you have to say.
Yes, the discussion, I guess, is going to be on the 60-40 mix. I call it the 40-60 because I've never seen a statement where we have stocks in front of bonds. So I call it the 40-60. And the 40-60 reasoning and why you had bonds in a 40-60 mix basically used to be that it provided stability, even capital appreciation potential at times of stock market rough patches, because bonds and stocks were negatively correlated in these times. And also, the cost of waiting between these volatile periods was not very large, with rates at 3, 4, 5%. And bonds did not represent a large risk of losing value. But I think these times are behind us, and I think we need to think about our bond portfolio and what it provides in a 40-60 mix.
I agree. I mean, when you think about that in that context, so you had a hedge, so you've got two levers in the portfolio where you've had interest rates go from, sort of 18 to 20% to zero. And so the cost of carry on the hedge was quite positive, right? Both from a capital appreciation perspective and, as you say, while you were waiting in bonds. And I know, Meb, you're famous for stating this, like stocks have not outperformed bonds, or if they have over the very long term, the long duration bonds, it's just coming together now. So it's not necessarily that stocks outperform bonds over all periods and all regimes. So we're now faced with the investor not having a huge tailwind, not having a massive positive carry on this non-correlated asset. And, if we look at the 70s, the assets of stocks and bonds were actually correlated. And so what do we do?
Well, Philbrick, you can remember the 70s. I can't so much. But as you look at the world today, I did a fun tweet yesterday where it was Vanguard's annual outlook. And I said, the average investor across any survey you can ever find expects about 10% returns. The average corporate pension fund, let's call it 7 to 8%, perhaps. They've got a little more sober in the last 10 years, but really around 7 to 8%. And Vanguard pegs the 60-40 global, by the way, at under 5%. So you have a pretty big mismatch if their expectations are correct on investor expectations and potential reality. And I mean, the bond part is easy. Like, what you're going to get with bonds. You're going to get essentially the yield, unless you move hard in the paint negative, and then you're really screwed then, because there's nowhere to go and nowhere to hide. So, if you look at bonds around the world this year, Canada and the U.S. are essentially like high yield markets I'm rounding up at 1%. Unless you want to venture into Pakistan and Venezuela and Zambia and all sorts of other countries, the developed world GDP weighted bonds are big fat donuts. And so bonds, people have always expected to hedge, and they did in the US this year. And I think potentially, in the future, some big crisis opportunities if and when equities ever get whacked again, is, the bond stock correlation isn't necessarily a given. Like you do not deserve to get bonds doing well just because you hope they will. And in a lot of the world, developed markets, bonds didn't help this year because they were already at zero or negative. And so when their equity markets got whacked, the bonds didn't really participate like U.S. Treasuries did. Will that happen? Who knows? But so the bond portion is known returns. And then what happens with stocks? Who knows? Maybe Elon Musk finds gold on Mars and diamonds and everything else. But that's the bigger challenge, I think, for a lot of people, is what do you do? And by the way, and Mike's been on this too, and I just want to get it out early because it always triggers me. In the most recent Schroeder survey, they asked people, what do you expect for your equity markets? And the U.S. investors said 15%. And I don't know if they were only polling the Robinhood crowd or what, but that number is so far out of whack with what is even possible that it just kind of makes you shake your head and say, this is going to be a bad outcome. Because as we know in life, not just in markets, but relationships, marriages, relationships with children, expectations and reality, when you get a big disconnect between that, that's when the real problems start to happen. So people expecting 10 to 15%, even 8, And Vanguard, by the way, they look at about 24 asset classes. There was only one that even had 8% potential returns, and that was ex-US stocks. So I'll pause there. May want to get all the depressing stuff up front, so we can.
Yeah, let's get it. Let's get it out of the way. I saw J.P. Morgan also came out with their expectations for the next 10 to 15 years were 4.2%. Right. So right in line with Vanguard. So Marc, how do you deal with that when you're talking with individual clients? So you've got a bit of a unique purview here. You're on the ground, boots on the ground, talking to individual investors. How do you help couch that? These basically unrealistic expectations with reality.
We try to under promise and over deliver. We've been using 4%. We do financial plans for clients on average once per day. So that's about 250, 200, 300 per year. So we've been doing this for a while. And we used to use 5% as a average return on portfolio for 40, 50 year horizon. We've changed that 3 or 4 years ago to 4%. So we've been performing a lot better than that, but we've been managing these expectations. But something funny has happened in the last 25 years is you used to buy bonds originally for the current income that it provided you and didn't expect capital appreciation. You used to buy stocks because of the capital appreciation. And if stocks paid you dividends, it was an added bonus. And what has happened in the last 25, 30 years is most of your return on bond has been capital appreciation, and most of the return on stock has been your dividend, which represents something like 50 or 60% of your return over 20 years has been the dividend. So things have been reversed. But now also one other thing has been reversed is rates used to be 15% and now they're 1%. So I think that people have to rethink their notion of what's going to contribute what to performance of their balanced portfolio for the next 10 years. So I think the discussion is very apropos.
Do you find you get pushback from individual investors on keeping those very sober and realistic expectations? Do you find some clients don't want to hear that and want to move to a different advisor who might be promising something more in the line?
It hasn't been our experience because first we've delivered more than the 4% or 5% that we use, and the flip side, if you buy the fact that you're going to earn, let's say, 10% on your assets, that means that you don't feel obligated to save as much, and you feel that you can retire earlier. The problem is once you've retired, it's tough to come back after being retired 5 years and change your standard of living. So the flip side of being wrong on your assumption of portfolio return is that you're going to have to work 5 years more or something like that. So I tell my clients that it's better to use conservative assumptions, revise it every year, and to make sure that our cost of living expectation and our retirement expectation is met. And if we happen to have a little more money, that'll be good. That'll be a good problem versus the opposite, which is a very bad problem to have.
Right. Well, and then I think I'll just change this conversation just slightly, because I also think that there's maybe a lack of recognition. Well, obviously, when we look at the return expectations on the equity side of the 60-40 portfolio, I think that people are missing the connection between what the risk-free rate is longer term and how that plays into a discounted cash flow analysis with respect to discounted cash flow assets like stocks, like real estate, like infrastructure. And I wonder, so we have an environment where potentially many assets are expensive. And I know you've got a bit of a purview on this, Meb, as well. So maybe I'll throw it over to you to talk about that a little bit.
Yeah. So this is the more uplifting part where, the base case in my mind, the Vanguard default market cap weighted portfolios, I'm a US based investor. So US is kind of bottom of the barrel. You have the bonds and stocks, Bogle said this. A fun way to estimate stock returns, listeners, by the way, is what we call the Bogle equation. There's 3 inputs. It's starting dividend yield, earnings or dividends growth, and change in valuation. And Bogle, before he passed, said, That puts the US about 4%. And as the valuations have continued up, we like to use 10-year P ratios. Doesn't matter. You can use any valuation metric you want, dividend yield, whatever. It keeps coming lower. Still positive, not a bubble, but the 10-year P ratio is right around 34, which is the highest it's ever been outside the internet bubble. But as I made clear on Twitter the other day, I said the first time we hit 34 in history was in 1998. Guess what happened next? The stock market went up by 50%. So it's no guarantee that it can't keep going up. And in the case of Japan and other countries like India and China, it's gone up to 50 or 60, or in Japan as high as 95. And so it's possible, right? But not necessarily probable. So the odds, like if you're at the blackjack or poker table, are that the U.S. has lower returns. And so the good news is, so expectations, like Mark, I think, was talking about, celebrate, drink the champagne, wake up the next morning, take a few aspirin, and take your medicine. Say, look, I'm going to expect 4% returns. Anything above that, gravy. Now, if you're willing to get weirder, the U.S. is half world market cap of the 45 countries around the world. We calculate it's the second most expensive country in the world across all the valuation metrics. That's the bad news. It's not a bubble, though. We don't think like the highest it was in the internet bubble, it hit a P of 45, but it's not good. The good news is the rest of the world is reasonable. Most other foreign developed countries are around PE of 20. But then if you go into emerging markets, they're in the low teens. If you're willing to be weird enough to go in the emerging markets, and the cheapest countries, a bucket of those are around 10. So pretty big valuation spreads versus the U.S. in particular, and that sort of oscillates over time. The U.S. isn't always more expensive. Over the last 40 years, there's been no valuation premium for the U.S. over the rest of the world. And at certain times, in like the 80s, the U.S. was much cheaper than the rest of the world. But if you're a global market cap investor, you put over half in the U.S. And if you're an American investor listening to this, you put probably 80% plus. Canada valuations are I think, not terrible, kind of in that foreign developed category, but not screaming cheap like a lot of Europe and certain countries. But also the way to think about, I think, a lot of this basic stuff too is valuation plays out over very long time horizons. We're talking years and decades rather than days, weeks, quarters, like many investors think about. And so this year is a great example. I would have said the exact same thing in the beginning of this year. And the U.S. is one of the best performing stock markets. And so, I would just put it on repeat again. But over the next decade, if you look at the decade prior, it's pretty rare for a country like the U.S. to outperform a globally average or GDP weighted. It happened in the 2010s. It hadn't happened before that since the 90s. Again, my favorite bubble when I was in university. Before that, it hadn't happened since 1910s. So it's not a normal situation. So you want to be globally diversified. And the good news of all this discussion, there's a lot of opportunity in the rest of the world, but you got to be pretty weird and different. You got to be willing to put money in places and tilt towards things like value, which most of the market cap weighted portfolio doesn't give you. There's no tether to value whatsoever. So there's a little bit of barbell, good and bad, in this discussion, and take your medicine. But if you're willing to move beyond your borders, I think there's a lot of opportunity.
I think it's interesting. Maybe tag on Meb your time frames that you're communicating with people too, because I think that actually dovetails well with that whole paradigm that you're speaking of.
I'll say this really quickly, and then I'll pause for a minute. We have over 60,000 investors as a public market investor, and invariably we have 12 funds. And someone will come up to me back in the pre-corona at a cocktail party. Now it's virtually. They'll call me or email me and say, "Meb, bought one of your funds. It's been disappointing over the last 3 months, maybe 6 months. I'm going to give it till May the next year, 6 months, 3 months. Why do you think it's done so bad?" And then no matter what, it's compared to the S&P, even if it's like a foreign bond fund compared to the S&P. And then say, why do you think it's had such terrible performance, and how long should I give it? And I used to say 10 years. And so when we were in person, they would laugh awkwardly, thinking I'm joking. And then, and now and this is very honest, by the way, I say 20. And then they're like, "What are you talking about? I don't have 20 years. That's crazy." I say, "Well, that's what it should be." And they say, "What are you talking about?" I say, "Well, let me give you an example. in 2020. There is no more universally held belief in all of investing. And you guys can come up with one if you know one. Listeners, think of one. Think of what the most universally held belief is in your head. And it's, in my mind, stocks outperform bonds over time. And I believe that's true. But when most people think over time, what does that mean to them? It means 2 to 3 years. And that's what every institution thinks too. They're just as bad as individuals. I'm not here just to dunk on those crazy retail Robin Hooders. The institutions like CalPERS and others I love to pick on are just as bad. It's 2 to 3 years. But this year in 2020, and the example I give in the US, because there's been a huge stock bond spread over the years, is that stocks had the same performance as long bonds. And this is in March. And obviously I'm cherry picking, but for 40 years, not 5, not 10, not 2 or 3, not 20, 40 years. And there's been other periods in many other countries where you have 50-year, 5-decade similar performance. And so this also, that's just asset classes. So every active manager or strategy, whether it's value or growth or high dividends or gold or streaming, whatever, goes through these periods. And so if you're not willing to give a minimum of a decade, and in particular, the approach I think is you allocate and set your sell rules up front. No one does that, say, here's why I would sell. And it underperforming a benchmark for 3 years is probably the opposite. You probably want allocating more, not selling it. But that's human. I think this is a really hard mismatch unless you have an advisor or have written automated rules and guardrails in place. You're going to muck it up. Like this is why I'm a quant. I had all these behavioral biases. I've been through it. It's painful. I don't know why anyone would want to, but until you go through that experience, and the sad part is people continue to struggle with it on all levels in investing. So your time horizon is way longer than you expect.
Yeah, I think you're right there. And diversification is the free lunch that you have to pay for, right? If you're going to have diversity in the portfolio, something's going to be killing it, and something's going to be killing.
I'm going to steal that.
So,
that's
Marc,
from your
perspective,
that's a great phrase. Is that a Philbrick original? I'm going to take that. You got it. I'll grant you license in the team.
Wait, well, I was going to say one thing I was going to say was that I was listening to a podcast with Raoul Pal and Jeff Gundlach a couple of days ago, and Jeff Gundlach, goes to what you're saying, Meb, which is that publicly what Jeff Gundlach said was that when they talk about their strategies, the farthest out they'll go is 18 months, because that's the sweet spot where that's all that the market can accept in terms of an outlook. That if you go out any longer than that, even 3 years or 10 years, you're losing people because they just can't withstand that much time frame.
Yeah, the tracking error that occurs over the time frame.
Well,
so Marc, how are you dealing with?
I was going to say, well, Jeff has mastered the narrative. He's so good at storytelling, and which, in my opinion, the investing approach you have, actually, there's so many that work. And as long as your expectations are aligned with that investing approach, you could buy 10 dividend stocks in one country, and God bless you, you'll probably do just fine. But you have to have the understanding and narrative of like what can happen. And so Jeff is one of the best in the world about this. He often has very contrarian views. He often makes big projections. Necessarily, they may or not ever end up in the portfolio, but he has very outsized opinions. But many different investing approaches work. You just have to have the right understanding of how they worked and what to expect.
That's one of the great things about this business, isn't it? Is that, everyone has the chance. Everyone could possibly be right at any given point in time. So, that's sort of the beauty of this business, isn't it? That's one of the things that you just have to love about it.
Well, and you don't know whether that rightness is a response to luck or to skill. That's probably the trickiest part of it. So, Marc, from your perspective, looking at expensive assets, so we've got yields at all-time lows. Bonds are expensive. That does translate into some equity markets being expensive. How are you navigating that, and how are you, helping clients behaviorally, helping or positioning portfolios and thinking
that's
about
basically
that.
what we do, because we're top-down portfolio managers. So I read about 3 hours a day, about 400 pages of research every day, and then most of it is top-down. So that's what I do, is allocate between industries, allocate between countries, and obviously the U.S. market has been performing very well on a worldwide basis over the last 10 years, exceeding all other countries' performance. But if you look a little more granular at where the performance comes from, and this will help you position for the future, is that when you measure portfolio returns or market returns at different geographies of the world, you have to put them in a common currency. And because of the fact that the US dollar went up 30-40% over the last 7-8 years versus all other currencies, obviously that helps explain part of the overperformance of common currency of the US market. So if you take that into account, and also the fact that you have to look at the sectors that represent the indices, the US market is one of the highest, if not the highest, market in the world that has a very strong component of technology-driven companies, and this has been performing very well. So the performance of the U.S. market is not really because it's the U.S., but it's because it has a strong weighting in technology stocks. So you have to ask yourself, looking forward, do I think that I'm going to generate the same type of return with the currency? Do I think that the sector that will be performing the best, considering pricing and perspective and regulations, we saw this morning with Facebook and a few weeks ago with Google. So how am I confident that the names that provided the excess return I got on the U.S. market will continue to provide this over the next 5-10 years? And I think you can raise the issue that is these, instead of being a tailwind, will be a headwind going forward. So this brings into context the notion of diversifying geographically into other markets that Meb referred to, that we've been strong proponents for many years. And of course, when you manage money, you manage on a relative basis. You don't manage in absolutes. I feel that the absolute return of the stock market will be less over the next 5-10 years than it's been over the last 10 or 20 years. So you'll have less return. That's my perception, is that even those stocks look expensive, and they look on an absolute basis, but you compare them to real estate, compared to the bonds and other types of investment possibilities for investors, I think stocks are less expensive on a relative basis than they were. I remember not too long ago, you could buy real estate, income providing real estate at 8 to 10 times your monthly rental, and now it's 25 times. You could buy bonds 5-10 years ago at 20 times because rates were 5%. Now you're buying bonds with 1% rate, so your PE on bonds is like 100 times. So there's much more exaggeration on bonds and even real estate versus stocks. So I think stocks will continue to provide better returns than the alternatives. It's just that the level of those excess return will not be as large as it was. And it brings into, but on the other hand, I think volatility will be as large as it's been before. So you'll have less return over time, but as much and maybe more volatility, because markets are stretched everywhere, which brings into concept the notion that the difference between strategic, we used to think that strategic asset allocation provided the vast majority of the return, and tactical asset allocation, which is the tweaking around the strategy, added some return, but most of it was strategic. Maybe over the next 5, 10, 20 years, I think you'll see a shift from the importance of the strategic towards the tactical, which will benefit from being more active and reacting to different volatility. And the impact on the tactical will be even larger, with the level of returns being lower.
Lots to unpack there. So I think we agree on some things. We've been a bit of a problem identifiers lately, which is to point out some problems. we've started to enter into the problem solving side of things, which is, hey, listen, there actually are some cheaper assets. So making sure you're being more broad, have a broader viewpoint of the horizon, and making sure you're considering emerging market assets, foreign assets. But again, those are stock assets. So you've got the risk-free rate, the ways for investors to make return. Risk-free rate, you've got betas, then you've got skill, which Mark, you were just talking about. Then you've got assembly, and then you've got rebalancing. And so those are largely the skills I think that we can come up with as ways to solve this. And I would say limiting the conversation to just stocks or just bonds is erroneous. I think we haven't talked about the commodities complex, gold, those types of assets. So what are your thoughts on really getting outside of the investor's comfort zone? And I'll add that the best performing asset over the last 20 years is gold. It's not U.S. stocks. And gold has also beaten bonds.
God, this is such a Canadian this is such a Canadian podcast.
I'm just observing a sacred cow. I am now slaughtering another sacred cow, just following in your footsteps.
I have a little Bailey's in my coffee, and I was waiting for the first person to say gold and how long it would it be. But I had 5-minute over under, so I don't have to drink it, thankfully.
I love it. So we're going to have to increase diversification. Liquidity, I think, is a function that has to be considered, because liquidity is your ability to change to changing circumstances. So I think sometimes the infrastructure, private equity, real estate assets can suffer liquidity constraints that don't allow for that adaptation that we should maybe address. And then finally, what are you guys thinking on the assembly side? But there's a lot there. Anyone want to take any of that? Run with it?
Just on the alternatives, because we talk of bonds and stocks, but I think one asset category which has been not very looked into in a favorable way over the last 20 years was cash. Cash was not, it was the leftover. It was not an asset category. It's something that that was there to pay the rent or pay the fees on your portfolio, something so really had no value. So you either had bonds or you had stocks. I think in a world where you have less relative return, you have more volatility, and where bonds represent a real risk of losing money versus what it was 10, 15 years ago, I think the value of cash has basically increased, and the return on cash will be viewed not as what is cash earning me while I'm holding it, but the option it gives you when you have volatile period to convert that cash, $100, remaining $100 for sure, into assets that have gone down momentarily in value. Then the return on the cash is the little return it gives you while you're waiting, but basically the option it gives you to participate, which bonds used to do, but now with rates so low and being more vulnerable to capital depreciation if rates go up a little, I think there's a risk element to bonds which didn't used to be there, which you don't have with cash.
And echoing on that, I think it's always seductive when you get a bunch of professional investors and allocators like this crew. We could argue and debate for like 10 hours on some of these super esoteric topics. And when you have certain investors listening, it's like listening to politics, right? Where often it's like the final 5 or 10%, as advisors, the things that I would say that we just assume are known, like, hey, how much you save and invest in the first place is going to dominate probably what your investments do. Next, you need to have a diversified set of investments, some global stocks, some global bonds, some global real assets, like all these things. And then we finally get to some of the areas that assume that you've done the first 80%. But a lot of people listening who aren't necessarily pros don't often know that. They think we're discussing like the whole kit and caboodle. And so this point you make about cash is so important, because so many investors approach investing as, I want to optimize the magical mean variance risk return. I want the highest return possible. And what you find in real life, it's not that simple. Most people universally, particularly once they've been through it, they look and say, yeah, I can take this much risk. I can take my portfolio going down by a quarter or a third or half. And then it happens and they're like, oh, dear God, like, no way. Because it often happens when everything else in the world is going, it hits the fan. So the economy is going down. People are losing jobs. They're the zombie apocalypse like this year. And the problem with most buy and hold sort of allocations is they have a pretty high correlation to what's going on in the real world. And so it all happens at once. So this idea of cash, gives you this. It may not be the optimal portfolio, but the number one rule of investing is you have to have a bankroll to play. You can't go to the casino and bet if you have $0. And so if you get taken out of the game, I mean, how many advisors have clients that said, 2009, I can't take it anymore. Sold all my stocks, never to buy any again. And then maybe in 2014, 2017 said, okay, now I'm ready to get back in. I'll get back in when things are more certain. Same thing this year. People probably sold everything in March. Can't take it anymore. Goodbye. Certainly in the internet bubble. And so the cash gives you not only that sleep at night, okay, I'm not fully maxed out, but also the optionality, like you mentioned, like, hey, when things go crazy and we find these massive opportunities, when real estate does go back to super attractive valuations and these people are forced into selling because they're over leveraged, it's a great thing to have around. And plus, that's the whole point of this, right? Like, remember, money is only a means to an end. And so, taking on just massive leverage, cash is underappreciated. Now, that doesn't mean you should put it under your mattress like my grandfather used to do, but, at least try to put it somewhere where it gets a little bit of yield. But I think that's a really important point you hit on, that once you've talked with enough clients and people, you realize is a benefit, but also a mistake a lot of people make. And particularly 2020, I think, has reminded us all that, hey, you need a decent cushion for when your emergency fund or when things happen, because people always say, I have this emergency fund and expect emergencies never happen. They happen like every year, something, right? So divorce, somebody gets sick, there's a pandemic, civil war, who knows? But I think that's one of the most important points that could be made.
Yeah. I was just going to say, I think it's interesting when people look at cash and there's both the opportunity cost and the opportunity that you guys are talking about, but it's kind of complicated, isn't it? When somebody like Ray Dalio comes along and says that cash is trash, that would motivate investors to do something other than holding on to their cash. It kind of complicates
Can I pick on Ray real quick? His co-CIO said one of the most preposterous things I've ever heard in all of investing. I mean, there's certain comments that if you make should disqualify you totally from commenting on a particular topic or subject. And not only that, it was like possibly the worst time ever. And it was in like Davos or something. And I'm going to get this slightly wrong. But he basically said in January that you're never going to have like a recession again, or like there's like the U.S. economy and stock market, is immune to, something happening. And I'll look it up while you guys are talking to get it exactly right. But it literally was like a month later. I was like, how you guys have and Ray in particular has such an appreciation for history and has seen all these things, Chinese stock market, Russian stock market, 1917, 1949 went to zero. Like, you see all these things that have happened. To make a statement like that is so preposterous. It seems so, weird. Anyway, sorry.
For anyone, go ahead.
Yeah,
go ahead, Marc.
I have a huge respect for Ray Dalio. At least he makes me think, and he has some perspective. And of course, it's right when you measure the performance of different asset categories. You look at stocks, U.S. stocks, bonds. So you say, if you purchase a bond, this is the return you would have made. Same with stock. And when you calculate the return of cash, basically you look at T-bills and say, this is the return of cash. But cash, people don't have cash to keep cash forever. They have cash for a certain period of time where if an opportune time comes, they will convert that cash into good investments. So when you calculate the return of cash and you don't calculate what's the impact of converted cash into depleted value of assets that you buy and make profit on, then you miss the point about cash. Cash is not the return you're getting while you're holding it. It's the opportunity it provides. But how can you calculate that? I know it because I've been doing it and using cash for 25 years. So I know the value of cash. But if you look at the financial table that gives you what has cash provided you for 25 years, I think you're missing the point.
Well, I think there's a couple things. Now I'm going to be defending Ray because Ray is an institutional money manager. So when you're talking about those 5 levels, you've got risk-free rate, betas, skill, assembly, rebalance, right? You are talking about skill. Ray is referring to cash as trash in the context of a risk parity portfolio, which takes a balance of all asset classes, weights them against the economic regimes, and that's your base portfolio. That is the no bet portfolio for Ray. And in almost all cases, historically, the risk parity portfolio has dominated the performance of cash, and it's done it with a very good Sharpe ratio because it's maximally diversified. And so if you want to think about the world from a preparation perspective rather than a prediction perspective, it makes total sense that cash would be trash. You're holding all asset classes in a risk parity portfolio based on the weights to the different regimes that could manifest. So you're always prepared. Thus, that portfolio outperforms cash over meaningful timeframes, which are meaningful to institutions, about 100% of the time. So again, the context of his comments, I think, is very important from the standpoint of what he means by cash is trash. What's interesting to me is he's also said that bonds are going to be challenged and are trash, which is maybe a function of the MMT philosophy passing through the Overton window and getting larger acceptance, where you're going to have yield curve control, you're going to have rate control, and bonds just aren't going to be volatile at all. And cash equals bonds. Thus, you have no volatility in the rate side, so that when you go through a period of deflation, you don't have bonds giving you that potential boost to the portfolio return. So it's interesting his viewpoint, and you have to understand where he's coming from, I think, which then leads to what are the other asset classes. So there is no safe haven asset now that's a layup.
And to your point,
right? It used.
Yeah.
So now
bonds,
what do we do?
Maybe rates won't be going up because they'll be managed by central banks. But the flip side is you're going to lose on the currency. So either the bonds rates are going to go up, or you're going to get clobbered by holding a currency that goes down. So
again,
that's right.
Currency is a relative game.
It's the same investment decision that you're making in allocating your resources throughout the world.
And more importantly, what's
that out is currencies.
Speaking of currencies, what's happening with the Canadian dollar? I'm trying to figure out where I'm skiing this year, and I'd love to get up to the Powder Highway, but this Canadian dollar, U.S. dollar, man, it's making some moves.
Might stay in Utah.
I may just stay local this year. See where
I'm not sure it's the Canadian dollar going up as much as it's the U.S. dollar going down. The dollar index ratio took a plunge since March, because it had gone up in March and then it went back down. And basically, if you look at the performance of the U.S. dollar, a lot has had to do in the last 10 years with interest rates in the U.S. being higher. So even though you saw the U.S. as a solidity and getting through the past recession in better ways, the rates were higher there than they were elsewhere. So that helped the U.S. dollar, and it helped returns on U.S. Denominated assets. But going forward, you could argue that maybe the way they're printing money in the U.S., maybe the U.S. dollar is going to be under pressure, and maybe you should have higher rates in the U.S., which is not going to happen because of the debt level. So I think the U.S. dollar is going to be under pressure, and I think emerging market currencies are going to be doing quite well.
So how does an investor take advantage of that, right? So again, in Ray's defense, he mentions explicitly currencies for that reason as being something that needs to be managed. So we've got the typical investor with a 60-40 portfolio. We've said, oh my gosh, bonds aren't going to do it. Currencies could be deleterious or beneficial, so we have to manage those. Are there any other easy opportunities? How about things like trading volatility? I know, Meb, you've got a fund that does that. So explicitly, just about every asset that you're going to buy is a short vol trade. And so having something in your portfolio that explicitly represents long vol in crisis may be an opportunity to provide further diversification to the portfolio. Thoughts?
Yeah, real quick. I mean, if you were to look at most traditional portfolios and say what's missing, the starting point for almost everyone is like you mentioned, a 60-40 or 50-50 stocks, bonds. Traditionally, it's in their own country. I talk sort of ad nauseum about this concept of home country bias. People put way too much money in their own country. In the U.S. of the global stock market, people put 80% in U.S. stocks. It should be half. It's even worse in countries like y'all's because the market cap as a percentage of the total is down, I think, 5%. And if people are putting 50-80% in Canadian stocks, it's a huge active bet and maybe a good bet, but it's a very active bet. And so the thing, and this is everywhere. This is Japan, Australia, UK, Brazil, Russia. Everyone does it now. So the first step is we always tell people, use the global market portfolio as a starting point. The global market portfolio, if you just bought everything in the world, all the public assets, you end up with roughly half stocks, half bonds, half US, half ex-US. And certainly you can tilt your own country and bonds your own country for reasons that are valid. But the good news is, so the things that are missing from that portfolio, moving towards the global market portfolio, is a lot of other foreign stock markets, which we've mentioned I think are a lot cheaper. And so having that exposure, I think, is a no-brainer. Second is people, I think, in general, they have real asset exposure, and you guys are a little different because you tend to have a greater appreciation for commodity type of investments, but most Americans I talk to don't. So under this real asset category, I'll put tips, real estate, and most people have a huge real estate portion, but it's just their house. And so that's very undiversified. So having both corporate and preferably residential real estate exposure globally, I think, is a big one. I love farmland investing, but that's a notoriously impossible asset class to allocate to. And then lastly is the variations of commodities. Those are no-brainers, but usually a lot of people are missing some of those in some format. The big three categories: global stocks, global bonds, global real assets. Usually people are woefully underallocated. And then you can get into the other weird stuff. I think the biggest opportunity right now is certainly value. Value has been absolutely demolished, not just globally, foreign markets versus the U.S., but within the U.S. this year. Small cap value is darn near down, I think, 50% this year in March. And so you have a scenario where the U.S. market has had some big distortions that give you some opportunities there. Then you start to get into active strategies. I love trend following. That'll be hour 2 or 3, which we haven't even got into. A fun white paper we did this year during the pandemic, which no one read because they were dealing with the pandemic, was basically about investing in markets at all-time highs. And the name of the paper is investing at all-time highs a good idea? No, it's a great idea. And the takeaway is that if you just bought markets at all-time highs and set a buffer like 5-10% and otherwise sat in cash, you actually did just fine. Anyway, it's free to download online. And then lastly, you get to something talking about volatility trading and tail risk hedging, which obviously looks great this year, but often is a cost. So many of these things are kind of in order. If you go down like the investment pyramid, we talk about the old food pyramid, how it's changed over time. It used to be you eat 10 servings a day of pasta, cereal, and everything. I think no one accepts that anymore. Although I did have a donut this morning with my son. It's inverted. And same thing with investing. Like you do all these basics and then you start to get to the end thing. So my big one here is global exposure, particularly value at this point, I think is going to be a monster, particularly emerging markets and emerging market. Most people have about 3% emerging markets, which is far, far, far too low, in my opinion.
Yeah, if you look at the performance of emerging Asia, it's pretty indicative of that, generally speaking.
Yeah, and one thing that seems as a very high level observation, but interesting is you look at the way, especially institutions, but even high net worth individuals have been acting, which tells you that they trust less bonds to do the job of managing volatility in overall portfolios, because rates have been low, and they're lower now than they've ever been, but they started being quite low 2, 3, 4, 5 years ago. And it's funny because this coincided with the fact that the popularity of private equity, real estate, bunch of assets which are not trading on a daily basis on the exchange have started to pick up. It's as if institutions started to realize that their bond portfolio would not be doing the same stabilization to stabilize the portfolios when stock markets went down. So we needed to find something else, and they couldn't find something else. So instead of buying an asset that the value is given every day, every second on the exchange, we'll buy an asset that really we can smooth the value. So they started getting more and more into real estate, into privates, a bunch of stuff that you don't have a stock market that gives you a value every second on it. So it gives the impression that the overall portfolio is not moving as much. So you're reducing volatility, as if investing in a small company when markets are going down 30% protects you, and the value, if you wanted to sell 100 shares of that company, that would go down also 30%. So I think by looking at the way the money is going, it's moving away from stuff that has the perception of being volatile. It's just the trading that's volatile. The real long-term value hasn't changed that much. It's not because markets go down 30%. The real value of the asset you're holding goes down 30% for the next 5, 10 years. It's a moment and a point in time when this happens. And it would also affect the other assets. But since they're not listed, you can't see that. So I think that one way that the institutions, in particular pension funds, have wanted to manage that volatility is going into privates. And you used to see that stuff that were not liquid used to trade at a discount, or the value was discounted. It was something like half. If you buy the same company, if it was on the exchange, you'd pay 2 times the PE that you would if you buy it privates. Now it's the opposite. The fact that you're illiquid is worth more. So people are buying from privates more than they would if it's listed every day. So this is a funny turn of events that I think shows that people are desperately trying to find something that's not subject to volatility.
And real quick, that's super important and interesting in this cycle, because every institution is counting on the private equity LBOs to be their savior. And there is a feature. I mean, the feature, what I used to consider to be a bug is a feature, which is you buy these, you're stuck holding these funds for 10 years. You can't get out. And that's a great thing for many of these institutions, because otherwise they would behave poorly, like all individuals would. As soon as they're underperforming, they would sell a fund after 2 years. So these long holding periods is good. The problem is, as the valuations, and everyone is herded into this asset class, as the valuation spread has totally collapsed, and in some cases inverted, like you mentioned, they still expect the outperformance. And that is the fallacy in my mind. All of a sudden, if you're counting on LBOs to be your savior and generate 15% a year to get you to this magic 8%, good luck. That made sense to me when you had these huge valuation spreads of the privates, but now you don't. And it's like they don't acknowledge that. But here's the hilarious thing is that you're in a business where you won't know the answer to that question for 10 years. So the career risk doesn't matter, because you'll be gone. If you're working at CalPERS and you say, all right, we're all in an LBOs, we magically project 15%, that'll get us to our 8. Well, 5 years from now, you'll probably be retired, sitting on a big pension, or moved on. And even if you're wrong, who knows, you can blame it on somebody else. And so it is an interesting setup. I think it's going to be a big problem in the next decade, is these pension funds starting to feel some real pain because of a lot of these expectations. Some of them are reasonable, but in my mind, it's going to be a problem.
And once you're in, you're in. And this is the point I was making earlier about liquidity. So they lack the liquidity for adaptation and change. And private equity is largely a bet on global growth with benign inflation and abundant liquidity. That's what it's a bet on. And if you start to change those dynamics, make them inflationary, compromise global growth, then you're going to be stuck with a bunch of LBOs that don't make sense. The cost of financing changes, the assumptions and the forward-looking assumptions all change, and thus the return stream changes. But you're locked in for 10 years, as you say. Like these are the implications of that asset class, and people are locking in at institutions largely locking in at all-time highs. I also think there's a I'll just finish. The last part is the halo effect, right? The vast majority of the returns from that asset class come from a very, very small number of deals. And so for an individual investor to think that they have some expertise or access is really a tough bar to cross in my mind from the standpoint of retail investors.
It's funny because anyway, I've been in business long enough that I remember way back then that the monthly statement you sent to clients of their portfolio didn't have market value. So it told you had 100 shares of BCE, 100 shares of CN, 100 shares, but you didn't have market value. So now the introduction of technology and everything, then they started to say, okay, now the monthly statement will put the value. And I remember investment advisors being traumatized. Oh, gee. What happens if it goes down? Because when they showed you only the value, you still had 100 shares after a month. But now maybe you still had 100 shares, but it was worth less. So brokers were terrified by this situation. So look back 50 years later, you see this private things. So people don't want to be seen to show the value of those assets. So it's quite funny. Yeah.
The more you look, the worse you do.
It creates a really nice optical illusion, doesn't it? I mean, that provides that emotional peace of mind.
It's the same logic as Meb was mentioning. You say, oh, you should buy these assets and keep it for 10 years or 20 years. So it would be much easier if we didn't have to provide the market value of those who say, buy this and we'll talk in 10 years. I'll tell you what you did. But now they have value every day. So it's the same concept.
All right, so I think we're drilling down deeper and deeper. Meb mentioned trend following. We're certainly fans of that. That's one factor of many. There's skewness, there's carry, all factors that you can layer in and add together to provide different return streams that are non-correlated to the general portfolio. Do we want to dig into that a little bit, or how much time do you guys have? Or
it's early morning here. You guys are the limiting factor. So let me know.
Oh, perfect.
All right.
Well, let's go in. So we've talked about some asset classes, right? So Meb, you highlighted that well. You got stocks, bonds, and the real bucket. That's going to have your gold and real estate and things like that. We talked a little bit about the vol bucket, or the tail hedge protection bucket, which is an interesting bucket, often underused. Well, now let's think about, sort of the factor type portfolios: trend following, global macro, systematic global macro, commodity trading generally. So if there is this sense of inflation, which I think there is, institutions, certainly from our perspective, there's an institutional interest from a real inflationary hedge basket in portfolios. So what about the strategy side? Maybe Meb, you talked about trend following. You could kick that off a little bit. Tell us what it is, what it isn't.
Let's start the base case first. I think this is important. A lot of investors don't have a clear understanding of this. If you talk about when you buy a passive index, there's really, in my mind, only one passive index. This was really popularized in the 1970s, which is the market cap weighted portfolio. So if you think of stocks, it's something like the S&P 500, where you're putting most of your money in the biggest stocks. So the stocks that are $2 trillion almost valuations, like Amazon and Apple, Walmart, Berkshire Hathaway, you put most of your money in those. So 3-4%, all the way down to the little guys. And the beauty of that investing style is that it hits upon something that's super important in investing in businesses. And I think venture capitalists really understand this. It's become much more obvious in public markets over the last 5-10 years. There's a lot of research papers that come out, and that is investment returns are dominated by power laws, which are the vast majority of returns are dependent on a small minority of stocks. So the McDonald's, the Amazon, the Walmarts that have gone up 10, 100, 1,000 times generate all the returns of the index. And that's the beauty of market cap indexing. You own more as it goes up and less as it goes down. So that's a great way to invest, great starting point. The problem with that, and that by definition is the world's greatest trend following strategy. You do not do anything other than buy more of a stock as it goes up and less as it goes down. The problem with that strategy is it has no tether to fundamentals whatsoever. So if you talk to newbie investors and say, hey, here's this index, they say, I invest in the US stock index. And I say, what does that mean to you? And they'll often say, well, it's the biggest companies. And I say, by what measure? And they'll say, well, like Apple, it's got the most earnings and revenue. I say, no. It's only price of the stock times shares outstanding. Company could have no earnings. It could have little earnings or revenue, like Tesla, and still be a top 10 stock. So that's the problem. So the good part is you're guaranteed to own the winners. The bad part is there's no tether to fundamentals. And so the problem with market cap investing is that when it gets to extremes, you tend to overweight bubbles and underweight kind of busts. And so any investing methodology other than market cap weighting usually outperforms market cap weighting. So equal weighting, value weighting, volatility weighting, doesn't matter what it is, historically will outperform market cap weighting. I mean, not by a ton. I mean, we're talking about like 1% per year, but usually worth doing it. Obviously, we are big fans of value. The two big pillars for us, value and trend. Value goes back 100 years, time of Ben Graham, certainly longer than that. Everyone understands value is applied to the rest of your life, buying your house, buying a car. It seems crazy in any other aspect of life not to use value. And then trend. And, trend as market cap weighting works great, but it also works on asset class levels in general. Value is something people get, so I'm not going to harp on that too long, other than it can go long periods of waxing and waning in the opportunity set, which I think is pretty fantastic right now. But it's also important on the value side.
You've got a bit of a unique view on value too, though.
Value is important because it's not just that you're investing in the cheap stuff. It's also that you're avoiding the expensive. And so it's like the old poem. It's like keeping your mind when everyone else is going crazy around you. Is that Kipling? Is important because it's easy to get it sucked into the story and the narrative of these companies. Again, like the 90s bubble, that was so much fun. I loved it, but there's usually an other side to the mountain too. And so the problem in 98, when stock market hit a valuation at 34 and then eventually on its way up to 45, went up 50%. Well, then you had over a decade of no returns. And in the case of Japan, you've had 3 decades of no returns. So the hangover can be severe, the bigger the party. So I love value, but it's not just about investing in the cheap. It's also about investing in the expensive. And then trend, you can apply that across asset classes, to asset classes. And the whole point of that, in my mind, it's equally as an attractive as a strategy as buy and hold, but for different reasons. The problem with buy and hold investing is you do nothing. So for a lot of investors, that's tough. Like you go down 10%, you go down 20%, and the advice is, look, you rebalance. We just buy and hold, and that's fine, but it's hard. It's hard for certain people because it often happens at the same time as everything else going to shit. Trend following is equally, I think, a reasonable strategy. The problem with trend following is you often look stupid, particularly compared to your neighbor, which is the worst stupid you could be because, Buffett talks about this. He says, it's not, people always say it's greed and fear that drive markets, but he's like, it's envy. So there's nothing worse than your neighbor getting rich, coming over and talking about his Bitcoin and talking about his Tesla stock. And today it'd be Airbnb and the vacation he's going on. Well, people don't go on vacations anymore, but the house he's buying, all that stuff. And so trend following is hard because you often look worse, when one market is booming or particularly in times of euphoria. And you tend to look better during the really long bear market. So it's a nice sort of yin yang. We are unique in that I don't know anyone as far as an advisor that allocates as much to trend, but we tend to be pretty oddballs, and I'm okay with that. that's just two perspectives. I'm happy to go into more later or in depth, but
I actually think it's interesting. So how does trend, and by the way, Meb's got just an absolute ton of research on this, whether it's asset allocation, comparing different ways of that, trend following, shareholder yield being a good measure of value. So that's all can be found on Cambria funds and whatnot. But specifically the personality of trend, like why is that complementary from a 60-40 perspective?
Because here's the problem with buy and hold. Let's say you live in Texas and you're overweight energy, which at one point used to be almost a third of the S&P 500 weight. Well, it's now at 2. And the energy sector is down, 70%. And that is not just almost irrecoverable from a portfolio perspective, because the sad rule of compounding is that there's a kink. And the further you go down, the more you got to go to get out. And down 50 means you got to go up 100. Down 75, which is where energy's at, you got to go up 300%. And meanwhile, there's often a lot of opportunity when things are down 60, 80, 90%, as long as they don't go to zero, like buggy whips. But the struggle is that you stay in the game. Back to what we talked about earlier. Like if you don't have any money, you can't play. And so trend following has the ability to say, you're going to get out as things are declining. The hard part, the cycle, and that does a good job if things are, in these long bear markets. So if you ask someone in Greece, Brazil, Russia, Cyprus, if trend following was helpful over the past decade, say, oh my God, save my behind. You have someone in the US said, no, it's been a detractor, because the biggest problem with trend following is you have a low batting average. You often have lots of losing trades. And people hate that. They love the certainty. So you have like 4 losing trades in a row. Are you kidding me? This system's broken. It doesn't work. Sideways markets are terrible for trend following. And trend following in the US has been atrocious the past decade, because the market will go up. It'll start to roll over and then ramp right back up. We've seen that a few times. Saw it in end of 2018, again in 2020. But in general, as far as like a desert island strategy, if you were to tell me, Meb, you got to put all your money in a strategy, I love trend following, because I think it's more, anti-fragile, more robust to at least all the possible outcomes. And let's be clear, going to zero sucks. That's a terrible feeling. There's nothing worse. So.
Absolutely. So Marc, on your side of things, what are those, are there any types of unique strategies like that you're bringing into the portfolio that explicitly target these sort of different factor exposures to complement the 60-40
prefer
portfolio?
To be a trend forecaster, trend follower. It works better for me. A lot more hard work, but no, and sometimes the factors, it's based on history too. What would this type of asset do in this type of circumstances? The circumstances change all the time. So they keep reviewing their model to adapt to new circumstances. So I'm not a big fan of systems that you put in place today that you can back test that it would have worked 10 years ago, but probably won't in the future, because stuff changes all the time. So I think you need to.
That's fine. So walk us through your process. What do you do?
What I do is I read.
What's your extra sauce?
That from people that are way more intelligent and knowledgeable than I am, and I read a lot, and I try to figure what's going to be the future. And it's tough to predict the future, but if you're right, it can be quite lucrative. But if you come back to the notion of value versus tech, I think what you have to realize is the notion of tech. I don't think Facebook is a tech company. I think in 10 years' time, we'll say this was anti-tech. It's not tech at all. It's not because you communicate with a computer that it becomes tech. And not everything that has to do with a computer is tech. So I have a hard time with that. But tech performed well in the last 10 years, 15 years, because technology company performed better. Their earnings went up in value more than value stock, which you can expect. But people one thing they don't realize is rates went down a lot. And it's like bonds. When you have a 30-year bond and rates go down, there's more pickup in the value than on a 3-year bond. And typically, tech companies pay less dividend, so therefore their duration, if you can adapt that wording for stocks, their duration is much longer than value. So when rates went down substantially in the last 10, 15 years, the impact on long duration stocks, which were tech stocks, was amplified. So it's not just that the earnings of the company in tech perform better. It's also the multiples you're willing to pay, and the impact of lower rates were amplified on tech stocks. But I think this will be tougher to achieve going forward. So I agree with Meb that value is due for a comeback. Will value perform better than tech? I'm not sure, but the difference between the return of both, I think, will be much smaller than it's been in the last 10 years, for sure. So I'm not a big fan of machine portfolio management. I think humans have to continue to have a significant value added. And I think that the 60-40, I think going forward, if I were to bet what would be the best strategy, I think 80-20 will be a better strategy. You put 80% in stock and 20% in cash. I think, and you're active and you're trying to forecast markets a little more, and you react to volatility, and you become actively involved. And I think this will perform better than the 60-40 that you don't move around, and with less risk, because the 40 in bonds, I think, is much more riskier than it used to be. But the 20% in cash has no risk, at least not in value. So I think this will perform better. And I think this idea will become more popular going forward as we go along, and bring into more in focus active management, which has been killed in the last 10, 15 years with passive management, which really seem to have performed better, although for individual it has not, because people, instead of being active with stocks, they became active with ETFs. So they were not really passive in terms of their investment. So really not a lot of people, even though a lot of people use ETF, not a lot are passive. So which basically they lack the same skills. It's the same skills whether you trade stocks or trade ETF. It's the same skill that is necessary to perform. So that's why you haven't seen people using ETF performing better in the last 10, 15 years than you have seen people using stocks before ETFs were popular.
This is the classic investor performance versus investment performance argument, exactly. Right? Which is that it's all the good behavior versus bad behavior, and so Marc, given that you believe in or that you're moving in the direction of cutting down the fixed income portion of a portfolio down to 20 and increasing the rest up to 80, what are some of the areas that are in the 80% that you think would provide the ballast? I think we've talked about value providing some ballast to growth, or versus trend following or versus growth. But what are some of the other areas in the equity portfolio that you would use that would provide that correlation or non-correlation?
Yeah, we're not there yet in terms of converting the 60 to 80 as a strategic weighting, but we've increased our allocation to stocks 5-6 years ago, and we just did that a few weeks ago. So the strategic asset allocation puts a little more emphasis on stock, but we're trying to compensate that by having more cash. We've been very strong holders of cash over the last few years, and it's performed extremely well for us. So, and we keep doing the same thing now that we've been doing for we've known each other for a while in terms of diversification. We have a strong percentage of our holdings in the internationals, and it's always been the case. And we're doing this in an active way. We believe strongly in Asia, and we have a strong percentage of our portfolios in Asia, Southeast Asia, China, Japan. Japan people, it's funny because they talk about Japan and say, oh, we're trying to avoid the Japanese problem. And everybody's saying with low rates and maybe debt level going overboard and everything. And people say, well, so Japan has been going nowhere for 20 years. Look at their GDP. It's one of the lowest in the world. What they don't realize, if you look at the GDP per capita of all the G7 countries, it's the highest in the world in terms of growth. So they're doing very well. So the headwind they've had is because their population is slowly being reduced as age, and let's say they're getting older and they don't have any immigration. But that's why the reason why there's some sort of stability on the political scene in Japan is because people are getting richer. There's less people of them around, but they're getting richer, which tends to favorize the stability on a political front. So I think Japan is going to continue doing very well, especially as Asia is emerging more and more as a powerhouse. And now they just signed a few weeks ago a common marketplace for Asia, so that's going to help. Europe is a basket case. Some are doing well, some not so well. So this is what we do. We read stuff and we try to allocate. And our horizon, even though our clients have a 10, 15, 20-year horizon, our horizon is not 20 years, but it's not 6 months either. It's 3, 4, 5 years. There's not stuff that I buy that I think is going to work well in 10 years, but not in 3 years. So I think there's a difference between 6 months and 3, 4 years. But past 3, 4 years, if you don't think it's going to work out in the next 3, 4 years, but in 10 years, well, wait 3, 4 years to buy this stuff. So that's our time horizon when we make moves. We don't trade a lot. We trade maybe 20% of our portfolio every year, which is not a lot. So we try to be right and not change our mind. But this year has been exceptional because markets, we hadn't predicted a pandemic. So, but we were a lot of cash and we're very active. So we traded a lot this year and our asset allocation has been doing very well. So this is what cash allows you to do. So people were asking us last year, markets are up 15, 20%. You have 10, 15, 20% of cash in the portfolio. It's doing nothing for us. But this year, we're not hearing that. So I think we'll have more occasions to do this over the next 5, 10 years. And as our clients are getting used to it, well, some of them have been used to it for 28 or 25 years. But even the new clients, I think that there's a rationale behind that.
Yeah, I mean, it's a very thoughtful strategy. I think you're just demonstrating that that as equity markets have become more valuable and more higher valuation, and bond markets the same, you've become more defensive and assumed larger and larger cash positions. So coming into February, March of this year, with the break of the pandemic and the break in the market, you were in a very advantageous position with cash. So I can see, it's easy to see why it's made you a bigger believer in maintaining cash positions throughout a historical allocation.
Because when you have a view over 5 or 10 years, you have to go where your beliefs are. I think stocks will perform better than fixed income instrument over the next 10 years. So I'm pretty optimistic about this. I don't know if the return will be 7%, 10%, 5%, but I'm pretty sure on average it's going to be better than bonds or other categories of investment. So I'm pretty confident with that. I don't know what bonds will be doing. Maybe rates will go up 1 or 2%. So I will lose money. I'm pretty sure I'm not going to lose money with cash. Maybe I'm not going to do a big return, but I'm not going to lose money. But there will be times where stock will get hit in the market. I don't care if I have 20 or 25% cash. I want this to happen because I invest that cash, I buy stocks, and I sell those in 6 months or 9 months. So volatility will become my friend. So instead of being afraid of volatility, now that I have the means to take advantage of it, it becomes my friend. So I think it makes sense. It reduces risk, and volatility is well managed, even not just in the portfolio, but in the perception of clients. I think it's a positive.
Yeah.
All right. Well, that has been a long and wandering conversation, gentlemen. I think we covered a lot of areas and topics and approaches to thinking about what to do with the 60-40 problem and 5,000-year lows and yields. You got anyone else have any final thoughts?
I think one area, just to put a final idea, that most people have almost nothing allocated to, as you think about emerging markets as the year winds down, it's always a good time to reflect. And two comments. One is that, most people listening to this are probably advisors or people that have advisors, but it's great time at end of year to reflect and, review your portfolio, because 2020 was a great stress test. Do you have your house in order? Obviously it was a painful year, but were the guardrails in place? Like a football team, American football team, did you have your game plan in place before you got to the line of scrimmage, or are you just winging it like so many investors are? But anyway, one investment opportunity, emerging markets, just put it in perspective. You ask most people what percentage of world GDP they think of with emerging markets. They think it's a fraction, but really it's over half. The U.S. is only a quarter, by the way. Emerging markets have 85% of the world's population, but stock market capitalization is only like 15%. And if you look at the tailwinds for the next decade, higher EPS growth, way better demographics, higher dividend yields, high real yields, and then screaming cheap valuations, particularly in the value sector, it's probably worth more than a 3% allocation in your portfolio. At least get back to the global average, which is closer to 15, which is 5x as much as most people have. At least think about it. Take a look. That's my final thing I'll leave you with. And as we do this again in 2030, we can reflect to see if that was good advice or terrible advice. I don't know. We'll see.
Agreed.
Whatever the Zoom of 2030 will be.
Yeah, maybe to
you have any final thoughts?
Put even more emphasis on what Meb mentioned is typically you buy stocks because you want to generate some growth. So do you weigh your geographic asset allocation based on size or on growth? If you're trying to achieve growth, you should go look for growth. And even though the emerging markets represent maybe 20% of the size of the world economy, they probably represent 75% of the world growth. So if this is what you're trying to achieve, you should allocate growth stocks to growth opportunities. And this is where they are.
Well, I would add that I think you should prioritize diversification. And I don't just mean that through asset classes, just stocks and bonds. I think you've got to prioritize asset classes that people aren't used to, whether they be emerging market stocks, asset classes like commodities and gold, asset class strategies like trend following and global macro strategies that respond well in liquidity crunches. I think liquidity is going to be something that's interesting. As you get the massive flow to passive, all of those active managers that were value players. Remember, value is someone who's not buying today in hopes of buying cheaper later. As they get shot and as the short players get shot, there is less and less of a buffer zone in future purchasers of all asset classes. Thus, the volatility, Mark, I agree with you, is going to be higher. And so you're going to have to think very thoughtfully about assembling the different bets that you have in your portfolio in order to maintain not only the returns, but the stability in the portfolio. And, I think that thinking about making sure that arithmetic return the geometric return in your portfolio can approach the arithmetic return is really what's going to matter to financial plans and for institution allocators as well. So those are the three things that I would urge people to think about and take away as they are managing through this very unique period. And I'll turn it over to Pierre.
It's been a really interesting conversation. So I want to thank you very much for your time and your energy and your passion and your views. We're honored to have you. And this is our inaugural episode. And so thank you very much, both of you, for being part of this show. And we hope to have you again in the future.
Thank you.
Looking forward to it. So fun, guys. Thanks so much. Have a great and safe and sanitary end to the year.
Thank you. And likewise.